Yeah, hello again. Here is another chapter of General Introduction to Tax Law. Now it's chapter 4.4, and this deals with the right point of time for business expenses and business revenues, or for simple expenses and simple revenues. The question is, do such things belong to last year, to this year, or to the next year? Because naturally, when you want to assess your profit or your surplus of income properly, then you must know to which year's tax declaration these things belong. Otherwise, the result would be rather arbitrary. So, just to give you an overview, the first question is naturally, where are we now in our testing scheme? The first step was, you remember that you always analyze the person, and that was personal tax liability. You ask yourself, is it a natural or a juridical person? Because that sets the decision between ESTG and KSTG. And then you find out if it's unlimited or limited tax liability in the case which you are dealing with. The next step leads then on to testing scheme step 2. You analyze the events. Yeah. Now let's look on the next chart. Here, analyzing the events is usually done in 3 steps. At least that's my personal recommendation. But if you need a technical term, analyzing the events is sometimes called the objective tax liability. So, first question is, which type of income does my activity belong to, where revenue or expense are combined with? You know there are 7 types defined in some paragraphs, and you have to find out what's the proper one. Then you ask yourself which tax base you need, profit or surplus, and you apply the rules for that computation. That is what we have talked about in the last chapters. And now step number 3 is, to which point of time does that all belong? So that is what we have to think about now. Let's look. So that is where we are now. So the question is, when is revenue taxable or when is expense deductible? The basic rule is to be found in section or paragraph 11 ESDG. 11.1 says when are revenues received, or when are revenues to be taxed? And the answer is basic rule in the year when they are received, and expenses are deducted in the year in which they are paid. So you can see that here also in my translation of 11.1 ESTG. Revenue is to be attributed to that year when the taxpayer receives it. A special rule, payment which have to be made in regular periods of time, regular payments, are to be attributed to that year to which they economically belong if the payment is made shortly before or after the end of the calendar year. Sentence number 3, a taxpayer who gets prepayments mentioned in paragraph 11.2, sentence 3, see below in a few seconds, may distribute them equally over the period of time for which they are made. We're going to discuss that later. And for revenue from dependent work, so from employment, the special rules in 30A, ESDG, and 43 remain untouched, so they apply instead of paragraph 11. And the rules on the determination of profit, so the bookkeeping rules, also prevail over paragraph 11. 11.2, treatment of expenses, the same game with a different sign. So that mirrors the principles which are applicable for receiving revenue. Basic rule, first sentence, expenses are to be attributed to the calendar year when the taxpayer makes them. Second sentence, regularly repeated expenses, for them, paragraph 1, sentence 2 is applied accordingly. So the short-term rule, or very often called 10 days rule. Number 3, sentence 3, if expense for letting somebody use something, rent and similar payments are or is, whatever English grammar demands, prepaid for a period of more than 5 years, then they have to be equally distributed over the period of time for which they are made. Sentence 3 is not to be applied to the disagio or damnum of a credit as far as this is usual and conform to market conditions. And number 5, again, the clarification that the special rules on determination of profits by bookkeeping and balance sheet and so naturally prevail. So they are special rules which derogate from 11. Okay, now let's think about that from the beginning onwards. What does it mean to receive a payment? What exactly is that? Well, a payment is received from the moment on in which the taxpayer can dispose about it. That means, according to the ESDH, that is the official hints to the interpretation of the ESDG, or you could also keep the H in the abbreviation by translating or calling it helpful information for the interpretation of the ESDG. Under the entry Zufluss von Einnahmen, so reception of revenue, the ministry says when you got economic ownership of the payment in question, so when you can dispose about it under normal circumstances and exclude others from taking it away, then you got a payment. By the way, when it comes to reading texts in literature, sometimes you see abbreviations ESDR. That is the abbreviation for Einkommensteuerrichtlinien. One might translate it with rulings on the ESDG interpretation by the fiscal administration. And there is ESDH, that's the hints concerning the interpretation of the ESDG. And the difference is plain and simple. The ESDH, the hints or helpful information, just mirror things which the courts have decided, whereas the ESDR, the rulings, are nothing else than the interpretation of the fiscal administration, so where they perhaps had a kind of a choice or where they had to make decisions, for example, which simplifications they accept in bookkeeping or which choice they prefer when it comes to the choice between several doubted interpretations. Yeah, so the general interpretation of receiving a payment, just to go on with that, the first thing is naturally you receive money or something at the earliest time when you can dispose about it. And one simple thing is you definitively could dispose about something when you did dispose about it. So imagine there is a quiz show on TV, that's rather a good example, where the candidate has just won 30,000 euro. And now candidate doesn't get the money but tells the moderator, I don't want the money. I say, give it to the Red Cross. Moderator says, okay, if you say so, we do it. Your money. Now, at the moment when the candidate ordered, I don't take the money, give it to the Red Cross. What the candidate did at that moment was dispose about the money. And evidently that meant if the candidate could dispose about the money, then at that moment it was already his money or her money. So disposing means there must have been the possibility to dispose. So you received the money when you gave a binding order about it. By the way, nowadays, when you watch the one or other German quiz show in a thorough way, sometimes the German variant of Who is Going to Become a Millionaire, or however it is called, does a kind of an extra evening with prominent candidates, and there is evidently an understanding that these people don't play for themselves, but that they have to refuse the money and have to give it to a social organization, a charity organization. By the way, if you just receive money and are never allowed to keep it, one could say you can never dispose about it, so you don't receive it. But they evidently have a good tax advisor, because um, every time when such a prominent candidate starts, um, the moderator says, well, in case that you win, which suggestion would you make to whom, to which organization we should give the money? So they are very, very careful. First, before even the game starts, the candidate has to confirm that he or she does not claim the money. Then the candidate does not give a binding order to whom that money has to be given, but the candidate is only given the right to make a suggestion, which the moderator will usually follow, but then the moderator acts on his own and does not follow an order. So they are really, really cautious in minimizing the tax risks there of a candidate who might be regarded as having received the money and then passed it on. Yeah? In my example here on the slide, the moderator and the candidate were rather risky, because here the candidate just said, yeah, I order that this money goes to. There was no previous agreement that you are only allowed to take part in the game if you renounce on your gamble winnings and pass them on to charity organizations. So in that case, candidate received 30,000 euro and passed them on. And now, if these 30,000 euro can be classified under one of the 7 types of income, which might work, for example, under the headline occasional services rendered, I am willing to come as a candidate and play on TV, then that would have been combined with potentially drastic consequences, because donations of 30,000 cannot be set off fully from the income. There is a limit of 20% of the income, so that could be a problem. Okay. Naturally, an amount is received at the earliest moment when you can dispose about it. So when you get money by bank transfer, then the bank transfer is ordered by your business partner on the 10th of the month. Then you cannot yet dispose about it because your bank has not got the money yet. Now, the money is credited by the bank on your bank account on the 12th of the month, but you only get the information when you draw the next bank account statement on the 15th. Now, clear fact, you could have received the money and disposed about it on the 12th already. Had you gone to the bank on the 12th, you could have seen the money is there, you could have spent it. So the time when you received it was on the 12th of the month and not later. Yeah, the same with a check. Imagine you get a check by mail on the 10th of the month, and now, surprise, if you bring it to the bank needs usually some 2 or 3 days before the money comes. But you received that check already on the 10th, and revenue is not only money but also any good or asset which has a value in money. And if that check is not what we in Germany call a foul check, so if it's not a rotten check which is not paid for, then this check has already a monetary value. So you received a revenue on the 10th of the month when you open the letter and get the check. So it's taxable at that moment already, which might play a role if you receive a check on the 30th of December and can only hand it in first moment to the bank, let's say on the 3rd of January, because of holidays and weekends in between. That plays no role. If the check has a value, you already receive that value on the moment when you get the check. Now you can also receive money by indirect ways. For example, you remember my example with the candidate in the quiz show. That candidate never got the money himself, but he just ordered the moderator just transfer the money directly to the Red Cross. So it does not come to me and I pass it on. We abbreviate the way of payment just by ordering a direct payment. But nevertheless, you got that money because if it's passed on your orders, the person who acts on your orders acts for you. So you receive it, the moderator on your behalf transfers it to the Red Cross. If the Red Cross is going to make us an attestation that it got a donation, you will be the person who donated in that specific situation because you were the legal owner of that money when it was given to the Red Cross. Also, the same applies if somebody pays off a debt for you or so. If money is paid on your behalf, then it is paid for you. That's the same way. That is also mostly only an abbreviation of the way of payment. Imagine your boss comes and says, here, I offer you an extra premium, a gratification of 1,000 for very good work. And now you say, boss, at the moment I'm nearly drowning in money. My situation is excellent, but I know that a friend of mine is hard up and really unlucky. And so my request would be, could you please, in an anonymous way, give these 1,000 euro to a friend of mine, to that friend in financial difficulties, so that I am never disclosed. Yeah. Now the money has been paid to that friend on the order of the employee. The boss acted on the employee's behalf. So what was below is natural. The boss wanted to make a payment to the employee wanted to make a gift to the friend, and these two payments were just abbreviated by paying in the direct way. And legally, you still have a payment to E and a payment from E to F. So it would be treated as such under tax law. So E received the money, same as in the candidate in the quiz show example. You also receive money if it is paid for you to others. The example in practice is usually when an employee has to receive a wage, let's say 3,000 euro, then the boss never pays out the whole amount to you yourself, to your bank account, but the payment will be split up into different parts. Let's say 500 are paid to the fiscal office for wage taxes, 500 for social security contribution, and only the remaining money goes to your bank account. Now you receive 2,000 in your bank account, but 500 were paid in your name to the fiscal office. So they paid your tax debts and that made you richer, and you received this money by the moment when it was credited to your account in the fiscal office, because it reduced your debts there, and so you received it. And your boss also pays on your behalf, so in your name, contribution to the social security institutions of 500. So you received that money because your liabilities with the social security institutions were paid off by your boss in your name. So the total amount of money which you received was 3,000, the gross income. That's the reason why this is always the basis for tax assessment. The same stuff now for expense payments. When do you make expense? Well, expense is made at the moment when the payer can no longer dispose of the money in question. If you give away something with a monetary value, the same applies. When you got rid of the asset, you have become poorer. That's a sin. Imagine Mr. P from Paderborn in Germany has to pay an invoice of 1,000 euro for something. He gives the order to transfer the money to the bank on Friday, but now the bank is a big fan of weekends, and so they only charge it to the bank account on the 21st. But now, from the moment onwards when you gave the transfer order to the bank, you were no longer able to dispose about the same money in a different way, because you bindingly said give it away, so you couldn't use that money for anything else in the meantime. So on the 18th, the expense was already made. One could manipulate things a bit. The payment date rule allows to shift things a bit. You decide when you pay things, and in certain ways you can also influence when you receive money. For example, if you take a telephone and just call the person who owes you money, could you please wait with the payment until the beginning of next year or so? Well, okay, usually that's possible. Now, in the moments or in situations where the delay is only a very small delay, the tax advantage from such a shifting of payments can be high, whereas the economic difference which it makes to you is relatively small. Imagine you just tell somebody, please don't pay my rent for December on the 31st of December, but please pay it on the 2nd of January. Then that income goes to next year. You would have only a small deviation. You only lose or have to wait 2 days for the money, but the tax effect could be considerable. And so the legislator tries to limit that effect. On the other hand, if you want to shift money to the future and it has an enormous economic effect, for example, if in June you have to get money and you take a telephone and just say to your customer, please only pay in January, then tax law will respect that, because, well, your income of this year will go down and next year will go up, but this is now combined with a considerable difference in the economic situation. Now you have to wait for 6 months for your money. Not everybody wants to do this, so in that case one would say, okay, if the taxpayer can achieve that, we can achieve waiting too, but not the short-term things. So manipulations might be easily done. Imagine self-employed person has a high income this year, 180,000, and now another invoice has been issued claiming 100,000 from a customer. Now, this year, the economic situation was already extraordinarily good, so you would end up in a very high progression with 280,000 euro, 45% marginal rate. Now, for next year, you can foresee that the situation will be near to a catastrophe. So you expect only 10 or 20,000 revenue at all. And so next year, the tax rate will be absolutely low under present circumstances. Now it would be an idea to say, okay, can't I shift these 100,000 to next year by calling my customer and say, does it matter? Could you please wait with the bank transfer until January instead of end of December? That would make a difference, because if I shift the payment to next year, then I have to pay taxes on 180,000 only this year, not the highest tax rate at least. And next year I will get off with 120,000. So the marginal rate will only be 42% also. And I can make use of that part of the tariff where the marginal rate is far lower than 42%. And otherwise, this low tax rate area would be lost next year. So that person will probably try to convince his customer to shift the payment to next year because that leads to a better distribution of income over time for him. Huh? Or might be business person has a year of 50,000. She regards this as rather too high and wants to lower her income for this year in a legal way as far as it is possible. So she prepays the January rent for the office rooms, 10,000, already on the 30th of December. They would have been due on the 1st of January. So only 1 day difference, but considerable tax effect. So she also might decide to prepay her Social Security contribution to the health insurance system for the next year completely already in December, 10,000 euro. So the income of this year would then go down by business expense of 10 and special personal allowances or special expenses, however you translate it, by another 10. So her income would drop down to 30,000 instead of 50,000. So taxes would be saved immediately. Well, next year will be next year's problem. That's evidently her attitude. That would perhaps be possible. And to restrict at least the possibilities to manipulate your tax base in that way, paragraph 11 contains that rule on regular payments which are made only a short time before or after the end of a year, before the beginning or after the end of a year. It just says if a payment is made only a short time before a year begins or only a short time after a year ended, and economically it is paid, it belongs to that year, it will be attributed to the year to which it economically belongs, and not to the year in which the payment was made or received. So payment is regular if it follows a rule concerning the point of time to which it relates. The fiscal administration also demands that it becomes due according to certain rules, but the courts say this is not in the law. So at least a regular payment is something which is repeated according to a rule every 3 months, every month, every end of a week or so. Then you can see that there is an economic relation. You pay for a certain period of time. That makes clear to which point of time or to which period of time that payment will regularly belong. And a payment is regularly also if the amount can be determined according to rules. So yeah, let's say the rent payment is always the same, or value-added tax payments for each quarter of a year or for each month happen regularly and have to be calculated according to fixed rules in the law. So you can clearly decide what is part of the regular payment. And now the courts say that a short period before the end, before the beginning, or before the end of a year is to be interpreted as a period of 10 days. If you speak about 10 days before the end of the year, one sometimes wonders, okay, half of these 10 years is a holiday. Does that make the period of days longer? And the answer is, well, half of the 10 years is always a holiday. The courts aren't stupid. So if they defined the 10 days rule as 10 days before the end of the year, they knew that 5 days or so usually are a holiday. Nevertheless, they spoke of 10 years before and after the year turns. And so it's indeed 10 days and nothing else. So the rule for regular payments is generally called the 10 days rule, and it has clear effects. The rent payment for January 02, if you transfer it already on the 30th of December, the payment is made in year one, but nevertheless, it is made a short period before the beginning of the year to which it economically belongs. It's clear you pay for January 02, you pay shortly before the year begins, so that payment belongs to year two under tax law. Another case, a lawyer has dealt with the divorce of a client and now can claim 5,000 euro from him and wants now to get that payment only on the 2nd of January of next year. This is a short period of time, within 10 days, but not a regular payment. Organizing the divorce of a certain person, of a given customer, is not a regular thing. At least I think we should hope that. It would be rather tragic if we have a client who carries through a divorce every 2 months regularly. Forget about that. Not possible. Individual single activities are not regular. So here you have indeed left over a certain factor for manipulations. And that will be respected apart from cases where one would regard it as clearly abusive. Tax abuse is if you formally do something which the law describes, but economically you do something different, or the other way around. Examples for the 10 days rule would also be the prepayments for value-added tax, which have to be made always 10 days within the end of the month or after the end of a quarter of the year. So if somebody has to pay value-added tax for the last quarter of year one, the payment is made on the 8th of January 02, then this payment still refers to year 01 because it's made a short time after the end of the year, and it economically refers to that year. So this is an expense of year one. A strange thing was that 5 years rule, it has been inserted some decades ago because there have probably been some people who thought about prepaying the rent for their office rooms for the next 5 or 10 years just to be able to lower their business profits of this year. Imagine you are an architect, you have made an extraordinary profit this year, let's say 500,000 or 1 million, and in all other years you only have an income of 50,000, then you might find it interesting to bring down that income of this year as far as possible. And so you might do things like I prepay my office room rent for the next 20 years. And so I reduce all my expenses in the future. And on the other hand, I lower my taxable income and my rate of progression this year. And then the law's answer would be congratulations, no chance. If you prepay such things for more than 5 years, that doesn't help. Then you have to distribute them equally over 5 years, over the years to which they refer. Up to 5 years, nevertheless, you could use that model because if you have small, independently working enterprises, sometimes they are hard up, and for them it might be economically a good idea to prepay expenses of the future, especially those which they desperately need to carry on. For example, social security contributions and office rent or other things which you need. The idea would just be I've got rid of all these worries, don't need to worry for the next 2 years or 3 years for my current expenses. I prepaid them. So even if I get sick, or even if the economy goes considerably down and my turnover drops down, I only need to make the money for food and drink, and all the rest is prepaid. That might be a considerable, genuine economic motive, and that is why the taxpayer allows people to prepay expense for several years, probably just to be on the safe side, and so as I explained. But after 5 years, they think, okay, this can now only be a tax trick, and so we are going to block this. If somebody prepays the office room's rent for the next 20 years, then please distribute that expense equally over time. Don't deduct everything at once. Naturally, if somebody receives such an enormous prepayment, the legislator is usually not opposed to taxing all the money immediately, but it would be equal and fair to allow at least the people to split up that payment also into equal parts for each year, which are then attributed to each year to which they economically belong, so for which they are paid. That explains why in 11.1 for revenue you find such an option if somebody gets such enormous prepayments. The thing with the enormous prepayments is rather theoretical, but if the rule were not existing, then it would happen in practice far more often, naturally, because then it would be a possibility to save some taxes, and people who can save taxes usually like to do this. Another aspect is for wages. When you work in a firm, usually within the month, specialized service providers will calculate for your boss all the amounts of taxes and contributions which have to be deducted from your wage. So imagine you have to get 3,000 euro, then such a specialized service provider will probably make the wage calculations, let's say on the 20th of the month, and pass over a letter with all that information, or the data with that information, to your boss. That's naturally then based on the assumption that your December salary is due in December, or will be the December one. Now imagine the bank transfer goes wrong. You have a claim to get your money on the 31st of December, but the bank data goes down, computers, and due to some strange repair activities, you only get your money on the 14th of January, so after the 10 days. That would mean that all the calculations would have to be redone, because probably in the new year Social Security contributions have to be calculated based on a different percentage. In the new year, the tariff is slightly different for wage tax and all that. And that would be horrible, because then all the calculations for tax and Social Security for all the employees which were involved in that mishap here would have to be redone. And to avoid this, probably we have a rule that regular wage payments, so your monthly wage, your weekly wage, and so what comes regularly in equal periods of time, that these things are always received for tax purposes in the year when the period for which they are paid ends. So when you are paid for December and your wage is paid on the 1st of January for December, then it belongs to December. If it is paid on the 14th, then it belongs to December, because it's paid for December. Only extraordinary additional payments, like a premium, a gratification, which you get out of the regular mode, additionally, these Additional wage elements will be taxed at the moment when they are really paid, because for them you can't find out a date when they should have been paid, or you can't identify a period to which they economically belong. That would just complicate things instead of simplifying them. So you have here a kind of a split rule. Regular wages are always received or attributed to the year for which they are paid, or where the period for which they are paid ends, whereas extraordinary payments, there the payment date counts. Naturally, when you have a balance sheet to make and a bookkeeping, then all of paragraph 11 is automatically cut off, excluded. Why? When you make a bookkeeping, then you don't book based on payments. You show expense and revenue at the moment when a decrease or increase of property is caused already. So when a customer has to pay, you already book the claim under accounts receivable. So you show yourself already richer. So revenue is there booked when the claim is caused. And on the other hand, liabilities and provisions are already entered into the books. You don't wait for the payment there. So when somebody makes a balance sheet, the whole of paragraph 11 is automatically overruled by the generally accepted accounting principles. So paragraph 11 only is applicable for those types of income where a balance sheet is not needed, or in cases where a business owner can opt out of paragraph 11, for example, where you can renounce on balance sheets in favor of a modified cash flow statement as defined in paragraph 4.3 ESTG. Well, yeah. Naturally, it must be understood that when you make investments, so when you buy a machine, when you buy a new computer or so, that then this is not immediately expense, so the payment also cannot be set off at the moment when you make the payment for such investments, for such assets. On the other hand, or instead, you have to depreciate the asset over time of its useful life. So here we have the special rule which derogates from the general rule, and so says whenever somebody in which type of income at all buys an asset, a fixed asset, that will have to be depreciated over the time of its useful life. The only exception would be if you buy a so-called low-value asset like a pen or so, €1, then naturally that would be horror if you had to estimate the useful life of the pen and depreciate the €1 over time. The same with if you buy something for €10. So low value assets usually are regarded as expense immediately. That's somewhere in the depreciation rules and valuation rules. You will come across that later in the course of your studies. But when you buy something which has a considerable value, let's say more than €800, you will probably have to depreciate the amount over time. Okay, let's make a short break here, and I'm going to come back after a minute, and you will not even see the minute or so. So just to sum all that up a bit in a nice overview, the rules for the point of time are simply the general rule, which applies usually is paragraph 11, the payment date rule, but that only applies if it's not overruled by a special rule, and there are many of them. The most important one first is balance sheet rules. When you have to make a balance sheet, then automatically everything is done according to the GAAP, the General Accepted Accounting Principles of German law. In other cases, the rules of depreciation also matter. You have the 10 days rule, you have the 5 years rule, you have the wages rule for regular wages, and you may have others. if they apply, and that allows you to fix something to the year to which it belongs. Yeah, in cases when you make a balance sheet and profit and loss statement, there is a last problem which remains, because when you close your balance sheet, you have one single result of accounting for the whole year, the profit for the accounting year. And then the question is, when will that profit be taxed? So there, the German rule in the ESTG and KSTG is that if you have a balance sheet for an accounting period which is either identical to the calendar year or which deviates from the calendar year, that does not matter. The profit is always received only on the last day of the accounting period, so on the date of the closing balance sheet. That would, for example, imply that if we have a GmbH, let's call it a GmbH, which earns 100,000 euro each month and has an accounting period from March to February, then the total profit would be 1.2 million, but all these 1.2 million would only be regarded as received by the owner of the business, so only received by a GmbH completely in year 2 on the 29th of February, so that this whole amount must only be taxed there. That, by the way, is a reason why an accounting year which deviates from the calendar year can in Germany only be chosen when you open your business, or later when you have first accounted for the calendar year and want to deviate from that. That can only be then accepted or chosen with the permission of the fiscal authorities, because a deviating accounting year would otherwise be a very great possibility to shift the profit of nearly a whole year into the next year, and so to have a kind of a tax holiday. Naturally, that is not one. Yeah, and last but not least, a short case again, so that you can see how testing such a case with our rules might work in practice. The guy who is our taxpayer is somebody living at Kleve, not married, because he wants to save us the efforts to calculate the splitting tariff and somebody asks you to determine his taxable income during the year of '02, not the firm, year 2. And he is the owner of a house which some years ago he bought for 200,000 euro. He has let this house to a tenant who pays 1,500 euro per month. The tenant has always paid correctly on the first of the month, but due to a banking error, the December rent was only paid out together with the payment for January in '03 at the beginning of January '03. The staircase had to be repaired and a window pane was broken. That caused repair costs of 2,000 euro for the staircase and 1,000 for the window pane. By the way, you see from the figures, I just guess around. I have no idea what a window pane broken might cost, and just forget about it. The figures are true because I say they are true, as always in cases which you have to solve in exams. The rule is never debate what is given as data in the case. The repair work was done in November, the staircase, and in December, window pane, and the payments were made in February '03. And for the window pane, the person doing the work insisted in a prepayment of 500 euro in December and got the rest in '03. The second thing which happened is somebody applied for a job in December. The application costs of 50 euro for the photograph, or for the guy who made the photograph, or the girl who made the photograph, one never knows with the English word photographer, and he sent round about 100 applications for a job. So that costs for stamps and envelopes, not antelopes, envelopes, 100 euro. And they all were paid in December, and he did not get a job until March 03. Furthermore, he was owner of a shop in Kleve which sells food. The profit of this shop, according to the balance sheet for year 02, was 120,000 euro. Yeah, so it was the balance sheet for the year 02, so from January to end of December. In addition, somebody is partner of a partnership in his home country, that is the country of Somewheristan, which is somewhere in the near, middle, or far, far east. Nobody knows where Somewheristan really is. It does not matter. From there, he derived a profit share of 40,000 euro, which is tax-free according to the double taxation treaty between the Federal Republic of Germany and the state of Somewheristan. Apart from that, somebody went on holiday in June, a cruise for 8,000 euro, and deductible private expenses for social security payments and similar things. The total is given as 20,000 euro, and that, ladies and gentlemen, is in all probability all what we have to deal with. So let's take the case and then slowly, one step after another, do whatever it takes. Okay, so here is our nice piece of paper where we can make our small notes. And we begin with step number 1, and step number 1 is naturally personal tax liability. And as always, it's plain and simple. Somebody, sorry, you see the typing mistakes never stop. That's going to last until I go to heaven or to hell, whatever it be. So it's an ESTG case. Now, somebody is resident of the German inland, Kleve. So unlimited tax liability under 1.1 ESTG. Now, if you do not feel sure exactly if it's really 1.1 ESTG, there is naturally now one step to take. Look it up in the Tax Act slides. So let's take them. Look for the ESTG and go to the contents, table of contents here. 1.1 ESTG, indeed, that is probably what we needed. Natural persons, yes, we have one. Who have a residence, yes, somebody has a residence. In the inland, yes, are subject to unlimited tax liability. Okay, that proves what we wanted to say. So that's it, and we can go back to the case. Yeah. Now we are through with personal tax liability, so objective tax liability comes next, and we have 2.1. The first event which we have is the house in Kleve. Question number 1, or A, is which type of income? And you know, letting a house for rent is nothing else than income from lease and rent. And again, there is this doubt showing up. Is that really lease and rent? And there is only one technology to find it out. Let's stop a bit and look it up in the Tax Act slides if we can find it there and check it. Yeah. Now we are through with personal tax liability, so objective tax liability comes next, and we have 2.1. The first event which we have is the house in Kleve. Question number 1, or A, is which type of income? And you know, letting a house for rent is nothing else than income from lease and rent. And again, there is this doubt showing up. Is that really lease and rent? And there is only one technology to find it out. Let's stop a bit and look it up in the TaxX slides if we can find it there and check it. So first go to the table of contents. Then we need paragraph 21, and here indeed 21 ESDG. Sentence 1, here the small number is the sentence. Here's sentence 2 beginning, but sentence 1 has a list. Number 1, income from letting for rent immovable property. And indeed, houses don't move apart from cases where you have a very big earthquake. And so houses are called immovable property, especially land, buildings, parts of buildings, ships, which are registered in a ship's register. Okay, that's a curiosity in German civil law. And rights to which the rules of the German Civil Code on immovable property are to be applied. Okay, so that's everything we need to be sure that indeed letting a house for rent is paragraph 21, number 1, income from lease and rent. So that helps us greatly, makes us happy, and we turn back to the case. So we can take that as a reference, 21, number 1, ESTG, income, no. And if it's income from lease and rent, then another conclusion is automatically true. So part of the worldwide income of the taxpayer, that is to be seen in the list of these 7 types of income in 2.1 number 6. And after we have got this, the next question we can pose ourselves is, which tax base do we need? Is it the profit or the surplus? And we need the surplus of revenue over expense. And if we need a proof for that, this is paragraph 2, subparagraph of section 2, number 2 ESTG. So we have to look for revenue. And revenue, is it here in the case? Well, the house is let to a tenant. The tenant pays 1,500 euro times or every month. That is revenue according to paragraph 8, section 1 ESTG, because it's money. Now they tell us it's always paid on the first of the month, but due to a bank error, the December rent is not paid in time. So rent for January to November is received on the first of each month. So in year 02, the year which is relevant here. See, and now where did we get that from? I believe that was our paragraph 11, but when everyone is not sure, there's only one method available. Look it up. So again, table of contents, paragraph 11. 11.1 is revenue. That is what we need. Revenue is to be attributed to the year when the taxpayer receives it. Well, that shows it in all clarity, which could have been needed. And we can even have a look already to sentence 2, regular payments, short time rule. And you know, short time, I told you that's 10 days. Perhaps we need that for the December rent. Okay, let's go back to the case. And so 11.1, sentence 1, ESTG. The December rent is paid only in the first days of January 03, but as it is a regular payment monthly, it has still to be attributed to year 02 because it is paid a short time after the end of this year. See 11.1 sentence 2 sentence to ESTG. Okay, so we have the revenue, and now let's look for expense. We have the staircase repair costs. They were incurred to secure the revenue. And now we should, in a case, not just state this, but illustrate it perhaps by some reasons. Tenants make trouble if they have to live in a house with broken staircase. And even if it's not a necessity, well, house doesn't look nice, so rent income will go down over time because okay, so income related expense under section 9.1 sentence 1, I believe, was the general rule for income related expense. No private consumer related advantage of owner to be seen. So paragraph 12 ESTG does not apply. Okay. Now, when are the staircase repair costs to be offset from the tax base? The payment is only made in 03, so belongs to year 03, not to the present year. See 11.2, was it 11.2 sentence 1 ESTG? And you know, tragically, let's look it up. Yeah, so 11.2. Expenses are to be attributed to the calendar year when the taxpayer makes them. And now we naturally still have to think about that short time rule, number 2, but this is only valid for regularly paid expenses, and the staircase is broken once, and so that's a single event. There can be no rule behind it, no regularity, and so we stick to sentence number 1. No, the expense belongs to the year when the payment is made. So as we know this now, back to the and now this was the staircase, and now let's call it B. Yeah. Or let's call it nothing. Just let's write the window pane repair is also income related expense because repair is done to secure the income from rent. You know, otherwise tenants in the long run will move out, or tenants will not be willing to pay higher rents in the future if they have some grievances. So it's an investment, and naturally you keep the house in a good state so that you can use it for future tenants for a longer time, all that. So when the payment is made, 11.1, no, 11.2 was payments made, sentence, ESTG, so 500 in December 02, and the remaining 500 euro are expense in year 03 January. No regular payment, so no 10 days rule applicable. C11 2 sentence 2 ESTG, because for that you need a regular payment. So we have naturally forgotten something, an expense which is not explicitly mentioned, the depreciation for the house. Under paragraph 7.4, number 2 ESTG, a house which has been built after 1924 is depreciated with 2%. The depreciation is 2% of the cost of acquisition. Here, 2% of 200,000 euros, so 4,000 euro. So we have a total for this event for this year of 12,000 coming in. Then window repair next year and window pane 500, 4,000 depreciation. So we end up with, oh my God, 7,500 euro. Is that right? I genuinely hope so. One never knows. And then the suggestion would be, let's move on to event number 2. This is 2.2. The event is application for job or jobs. This is clearly relating to income from dependent work or from employment, however you translate it. And you can see that in section 19, paragraph 19, on number 1 ESTG, everything which has to do with services, a job for a private or a public employer. So it's part of the worldwide income under 2.1, and now I know that from heart. You should look it up. 2.1 number 4. The tax base for income from employment is the surplus of revenue over expense. That is again a standard reference to number 2. So let's look for revenue. And there is none. Expense, the costs for the photograph, 50 euro, and for the mails, 100 euro. Those are incurred in order to get a job. So income related expense. One ESTG. A private advantage is definitively not connected with the mail costs. Sending applications to a future employer has probably really no private consumer related advantage. Might be seen in connection with the photographs, but here usually the wish to get a nice application photo would be regarded as the predominant motive, and a possible private advantage would be regarded as immaterial. Nevertheless, in case when you apply for a job and go to a photographer, then it is probably not the best solution to use the same photograph which was made for your job application afterwards on Facebook or another social media as your profile photo, because then you would definitively have used it naturally for private purposes, and then you would have mixed expense. There would be no way out. Yeah, when point of time, at the moment of payment, here December 02, C11(2) sentence 1, no problem. They refer to something which happened in the year 02. There is no economic relation to what happens in the next year. There is no matching principle that the expense must be attributed to the years when the revenue comes. And apart from that, this is not a regular payment or so. So we have here a total of minus 150 euro from income from employment. And indeed, that can happen, that in a certain year you have a negative outcome concerning the income. No problem. Income from a type of income can be positive or negative. Shop in Kleve. This is income from business. You will see that in 15.2 ESDG, in combination with 15.1 number 1 ESDG. 15.2 says what a business is, and 15.1 number 1 says who has to pay tax, who has the income from the business, and number 1 is sole tradership. Well, in case of a sole tradership, the owner of the shop is the owner of the income. Tax base for income of employment is the profit. This is now 2 number 1 ESDG, and the point of time is the closing date of the balance sheet. And here, yes, that was 4A for a natural person. Paragraph 2 number 2 ESDG. If there is an accounting year, the date of the closing date is the date when the profit is received. That is here the 31st of December 02. So profit of 100,000 euro is attributed to year 2. Total of this is plus 120,000 euro. Okay. Let's go on, because if we don't go on, we would go under. And we don't want to go under. 2.4. Partnership in somewhere start. That's a profit share. So yeah, he is a partner, so he does not run the enterprise there alone, but together with others. Let's begin again at the beginning. So the type of income, it's income from business. 15.2 again, in combination now with 15.1 number 2, which says in case of a partnership, every partner has to pay for his or her profit share. The tax base is the profit again. Here the profit share, that was 2 number 2 ESDG, and that is given here with 40,000 euro. Due to special rules, this amount is tax-free. Nevertheless, it counts for the calculation or for the auxiliary calculation to determine the tax rate. That was the proviso safeguarding progression, or in German die Progressionsvorbehalt. So total taxable 0, tax rate relevant plus 40,000. And clear 2.5 holiday. And the answer is no type of income, private expense, not deductible from the income under paragraph 12 ESDG. So relevant 0. The only possibility how you could deduct private expense would be if it's explicitly allowed for deduction under the rules for private expense, for special expenses, or for extraordinary expenses. So unavoidable financial burdens which really hit you, which are unavoidable for you concerning their cause and their amount, and which don't happen to all other taxpayers in similar financial situations like you are. Forget about that. This is definitively not the case here. So 2.6, we have now deductible private expenses according to case data of minus 20,000. So let's go to third, summing it all up, or adding it all up. Well, now we have because of number 1, and now permit me to go back for a second. The total of number 1 was 7,500. The total for number 2 was minus 150. For number 3, plus 120,000. Minus 150 plus 120,000. Number 4 is now on this page 0. Tax rate relevant plus 40,000. And number 5 was 0. Number 6, the special expenses and so on, minus 20,000. They are always relevant. There we end up with a total. Now let's calculate. Oh my God, 120,000 plus minus 20,000 is 100,000. Now 7,500 minus 107,350 is probably our total. I hope so, ladies and gentlemen. Now I'm a bit nervous, so I can't check that. Or let's take a calculator. That might also be a good idea. 7,000 seems to be so. Yes. Oh, impressive. And relevant for tax rate is 40,000 more, so 147,350 euro. Good. Tax calculation. That is now something where we have to go to the tax tariff. That was in 32A 1 ESTG, and nobody on earth knows the tax tariff by heart, so we will look it up. I try to find the most recent version in my Tax Act slides. Naturally, if, for example, you in future years see that video, then you must remember this is the 2020 version, and you will have to update the results by applying the more recent tariffs of future years. Okay, but let's look up first. And indeed, I found in my translation also the version of the tariff for 2020. And you see it here. And now we have to remember which tax rate relevant income we had. And that was something with 147. So we need this, the fourth bracket. So 42% of everything minus a correcting factor of 896374 euros. And that will be our formula, which helps us to calculate the adequate tax rate. So let's go back to the case and do a bit of mathematics. So the calculation formula was 42% of everything which we have to take into account. And for the tax rate, we have to take into account that the worldwide income of our taxpayer is higher than the taxable one. So that was this here. Now we have no chance without a tax calculator. 147,530 times 42%. This is 61,96260 probably, minus 8963. 74. This is 52,99886. This is usually rounded down to equal to even euros. Now we only need that tax rate calculation in order to find out to which tax rate that corresponds. That corresponds to a tax rate of, now of, no, not of, 98 divided by the tax base which we used for that. That was no, not 530, 350. Okay, I have spoiled it all. Ladies and gentlemen, what a catastrophe, everything wrong. These are the usual mistakes. 147, 350 times 42%. This is 61,887 minus 896374. So also here another value comes out slightly different. 52,923.26. The 26 cents vanish, and this is now divided by the figure which we used to calculate it. And this is 35%, 91,652%. There is probably a rule how you have to round this down, but I take as many figures behind the comma, which digits behind the comma, which I can find to be as exact as I can. That tax rate applied to the taxable income of 107,350 leads to an income tax of 35.16% times 107,350. Here's again the same typing mistake. And let's have a look. 107,350. What comes out? 38,556 38 euro, and this is again rounded down. So this, ladies and gentlemen, sorry, this is our final, very final tax rate, tax amount. So here we are, nothing else is left over. So case finished and finished. You see. So there are people who have learned during their lifetime to deal with tax cases, but they have forgotten how to read and write and how to calculate. Well, so beware that the same doesn't happen to you. Yeah, that's it. Over and out for today. I hope that gives you a feeling of genuine happiness. At least for me, that's the case. Enough for today, just to repeat it. Joy and happiness are now, which must be, which is on the timetable now. But before we leave, don't forget to practice cases in the way in which we just did it. So give reasons for every step which is necessary to arrive at the solution. Give references to the tax acts. Always use the tax act slides to find the necessary reasons and references, or the statements in the law which make sure that you are right and which prove that you are familiar with the law. And if you need far more time still for solving the case that I just solved, then you are not yet well trained and need to practice, practice, practice. And with that comforting insight, I leave you alone now. Hate me for a minute and then sit down and do some practice and exercises. It was a pleasure to talk to you. And probably it's a pleasure for you now that I stopped talking. So that was a pleasure for everybody today again. And that's a good and fair world. I say goodbye till the next time. Ciao.